Hey guys! Tonight we're diving into something a lot of people won't admit to feeling, but it's there, lingering like a shadow over every financial decision you make. Yep, I'm talking about the fear of losing money. And if you're honest with yourself, you probably feel it, too. That gnawing little voice inside, whispering that one wrong move could bring everything crashing down. Now, here's the kicker. You probably won't survive this. But don't worry, you won't be alone. Everyone deals with it. I mean, who doesn't get a little jittery when thinking about risking hard-earned cash, right? So, before you get comfortable, take a moment to like the video and subscribe, but only if you genuinely enjoy what I do here. And while you're at it, drop your location and the time in your area. I'm always curious where everyone's tuning in from. Now, dim the lights. Maybe turn on a fan for that soft background hum. And let's ease into tonight's journey together. Let's start with the basics. That fear of losing money. It's more than just a passing thought. It's a psychological block that keeps you from making decisions that could propel you forward. It paralyzes people into inaction. The more you fear losing, the less likely you are to act. And the less you act, the more you miss out on opportunities. Take a moment to think about it. What's the worst thing that could happen if you tried to invest in something new or took a risk on a business opportunity? Sure, you could lose the money. But that's hardly the end of the world, right? Funny thing, though this fear isn't new. In fact, the ancient Greeks had a word for it, pania, which translates roughly to a fear of losing wealth or status. Historians still argue whether this ancient fear was as pervasive as our modern one. But it's clear that this fear has been around for millennia. Over time, it's become ingrained in our psyche. We associate wealth with security and stability, and anything that threatens that can seem downright terrifying. But let's flip the script for a second. The more we live in fear of losing, the more we let that fear dictate our lives. It becomes a self-fulfilling prophecy. Here's the deal: you have to acknowledge the fear, but then you have to do something about it. And what better place to start than by understanding why this fear exists in the first place? The reason is simple. Humans are wired for survival. It's instinctive. You're designed to avoid risk, to stay safe. But here's the problem with applying that same survival instinct to money. You're not in the jungle anymore. There are no saber-toothed tigers, no predators lurking around the corner. The risks you're facing now, they're financial, not life or death. So the first thing you need to do is separate survival fear from financial fear. They're not the same thing. When you understand this, you realize that risk and reward go hand in hand. Every time you make a financial decision, you're balancing the risk of loss against the potential for reward. And if you're so wrapped up in the fear of losing money that you don't even try, then you're locking yourself out of the opportunity to gain. You're keeping yourself stuck in that comfort zone, which, as tempting as it may seem, is exactly where growth goes to die. If you stay in your comfort zone, your financial journey will feel like a slow trudge, like walking through molasses. Sure, it's familiar and safe, but you're not going anywhere fast. To make money work for you, you have to break free from that comfort zone. The world of investing and wealth building isn't about staying safe. It's about learning to make smart decisions despite the risks. Think about it. If every successful investor stayed in their comfort zone, would they have ever built an empire? This brings us to the next part of the journey, understanding how to break free from that fear and step into a space where smart, calculated risks lead to smarter, long-term choices. It's time to get comfortable with discomfort and to see that fear not as a roadblock, but as a clue that you're on the right track. All right, so you've acknowledged the fear. Great, but now what? You're probably wondering how to escape that sticky comfort zone, the one that feels so cozy, but also, let's be real, is keeping you stuck. You know the one. It's like that oversized hoodie you refuse to throw away, even though it's fraying at the sleeves. It's comforting, but it's not helping you get ahead, right? Let's take a step back and dig into why we end up there in the first place. The comfort zone isn't just some imaginary place. It's a psychological phenomenon that keeps you in a state of mental equilibrium, safe, secure, and free from risk. This isn't necessarily bad in every situation. If you were, say, stranded in the middle of nowhere, you'd want to be in a place where you feel safe. But the problem with the comfort zone in financial terms is that it's a holding pen, a place where nothing new happens and nothing changes. No growth, no wealth, Now, let me give you a little historical tidbit to put this into perspective. During the early 19th century, many of the world's great industrialists took enormous risks. Men like Andrew Carnegie, who rose from poverty to become one of the wealthiest men in the world, didn't do it by sticking to what was familiar. He jumped headfirst into risky ventures, like the steel industry, which was incredibly volatile back then. You could say he was living on the edge, but it paid off. Historians still debate the morality of these industrial moguls, but you can't deny their success was a result of embracing risk. That's where the real kicker is. The more we cling to the familiar, the more we miss out on potential opportunities. It's like standing on the shore, watching the waves roll in, and never daring to swim. Every successful person, you know, whether they're a business mogul or a local entrepreneur, had to step out of their comfort zone at some point. And here's the dirty little secret. There's no magic formula for success, just a lot of uncomfortable moments that lead to breakthroughs. Let's get back to you. How can you break out of your comfort zone without feeling like you're about to take on a grizzly bear with your bare hands? The trick is to start small. Take calculated risks. Start with something that doesn't throw you into the deep end right away, but still stretches you. Maybe it's investing a small amount in something new, or taking that business course you've been thinking about. Whatever it is, just get moving. The more you take those small, manageable risks, the easier it becomes to take bigger ones down the line. Now, I know what you're probably thinking. That's easy for you to say. Warren, you've already made it. And you're right. I've been in the game long enough to know that this isn't about luck. It's about making decisions over time. The best way to make smart choices is to make consistent ones. And the more decisions you make, the less intimidating they become. So how does this all tie back to money? Well, when you're stuck in that comfort zone, you might think you're avoiding risk. But in reality, you're avoiding growth. You're playing it so safe that you're robbing yourself of the chance to create wealth. It's like staying on the sidelines during a game because you're afraid of making a mistake. But guess what? You can't score from the sidelines. You've got to get in the game. Make those small moves and start building your financial confidence. Let's talk about why this comfort zone issue tends to keep us from even considering long-term investments. There's a real fear of making the wrong choice and losing money. But the truth is, even if you make a mistake, it's not the end of the world. Mistakes are part of the process. Every time you fail, you learn. It's only when you stop trying that you truly fail. Imagine this. You're standing in front of a massive buffet, but instead of grabbing your plate and diving in, you're just staring at it. Too afraid to pick anything. You're waiting for the perfect dish to show up. But here's the thing. The longer you wait, the less you eat. And eventually, someone else will grab your plate. This fear of making the wrong move or choosing poorly paralyzes so many people. And in a way, it's understandable. But the opportunity to grow, to learn, and to make smarter financial choices lies in the very act of trying, failing, and adjusting along the way. That's the path to success, not the one where you stay stuck in your safe little bubble. This is where the concept of long-term thinking comes into play. You see, while you're sitting there thinking about the next big move or the next investment, what you really need to focus on is where you'll be in 5, 10, or 20 years. It's not about that immediate fear of losing. It's about where those small, consistent steps will take you over time. You're playing the long game, and that's where true wealth lies. So, now that we've talked about getting out of your comfort zone and the importance of taking risks, let's get into something that will ease your mind as you make those decisions. Long-term thinking. This might sound a bit like a buzzword, but trust me, it's the golden ticket. You see, the fear of losing money is often rooted in short-term thinking, looking at every dollar as though it's the last one you'll ever have. But in reality, building wealth isn't a sprint. It's a marathon. And to run that marathon, you need a strategy, a mindset that focuses on the future rather than the immediate now. Let's take a quick detour into history. One of the key figures in promoting the idea of long-term thinking in investing was none other than John D. Rockefeller. Rockefeller, the wealthiest American in modern history, adjusted for inflation, didn't amass his fortune by chasing short-term profits. He invested with the long term in mind, building his oil empire slowly, over decades, with a focus on stability, efficiency, and innovation. Historians still argue about the ethics of his business practices, But one thing is undeniable. Rockefeller's focus on long-term growth and control of resources is a big reason he was able to weather economic downturns and market crashes that would have sunk many others. But here's the thing. Long-term thinking isn't just about stacking up money for the sake of it. It's about building a foundation. Imagine you're planting a tree. At first, it's tiny, fragile, and maybe a little shaky. But over time, with the right care, it grows strong and tall. The same principle applies to investing. Early on, it might feel like nothing is happening. Your money might seem to be just sitting there. But trust me, patience is your ally. Over time, that little tree becomes a sturdy oak, providing shade, shelter, and most importantly, growth. Now, I know what you're thinking. Okay, that sounds great in theory, but how do I deal with the panic when things go south? What happens when the market crashes, or I lose money? It's a valid question. And let's be honest, market fluctuations are unnerving. You check your account balance, and suddenly, your portfolio's value has dropped. That sting. It's real. But here's where long-term thinking shines. When you invest with the long term in mind, you're not panicking over every dip and spike. You're looking at the big picture, understanding that markets will rise and fall often in cycles. In the short term, the stock market behaves like a roller coaster. One moment it's up, the next it's down. But when you zoom out and look at a 10 or 20-year period, you'll see a general upward trend. As daunting as it might seem to watch your investments take a hit in the short term, it's important to remember that you're playing a game of time. Think about it. Some of the best investment opportunities come when the market is down. If you sell when things are bad, you miss out on the chance to buy at a discount. This is why emotional reactions, especially panic, can be your worst enemy. You can't let fear dictate your choices. If you're only focused on the here and now, you'll never have the opportunity to see how your investments can grow over the next few decades. Here's where having a solid, long-term strategy comes in handy. If you've done your homework, if you've researched your investments and feel confident in your decisions, there's no reason to jump ship at the first sign of trouble. Remember, even the greats like Rockefeller or Warren Buffett, you knew I had to mention myself, right? Had to weather some pretty rough storms. The trick is not letting those storms shake you to the core. And don't get me wrong, losing money stings. It hurts. But it's important to remember that every investor has faced setbacks. The trick isn't in avoiding losses, it's in knowing how to bounce back from them. That's where the real learning happens. Every loss is an opportunity to reevaluate, adjust, and make smarter moves next time. But it's not just about the market. Long-term thinking also applies to how you manage your wealth. For instance, when you're building a portfolio, you need to consider things like diversification, risk tolerance, and the fact that your financial goals will change over time. What worked for you in your 30s might not be as effective in your 50s or 60s, and that's okay. The key is to evolve your strategy as you go along, always with a focus on long-term success. Speaking of diversification, let's take a moment to explore the benefits of having a varied investment portfolio. This is another essential element in reducing fear. When you spread your investments across different asset classes, stocks, bonds, real estate, etc., you're not putting all your eggs in one basket. That way, if one investment takes a dive, you have other assets working for you. Over time, this helps to stabilize your portfolio, making it less vulnerable to market fluctuations and reducing the emotional stress that comes with watching every dip. The long-term mindset also extends to how you approach your overall financial goals. Whether you're saving for retirement, buying property, or simply building a cushion for emergencies, you need to keep the big picture in mind. Short-term wins are nice, but it's the long-term strategy that will make a real impact. So, as you continue on this journey of overcoming the fear of losing money, remember, it's all about patience, consistency, and, most importantly, time. When you adopt this mindset, the fear of losing money starts to fade into the background. You begin to see it for what it really is, just another bump on the road to wealth. Now that we've talked about the power of long-term thinking, it's time to take things a step further. The beauty of failing fast and learning faster. Let's face it, nobody likes failure. It's uncomfortable, sometimes embarrassing. And let's not forget that sting of regret. But here's a truth bomb. Failure is essential for growth. If you aren't failing, you aren't trying. If you aren't trying, you're not learning. It's as simple as that. This idea of failing quickly isn't new. In fact, some of the most successful people in history have embraced failure as part of their journey. Take Thomas Edison. For example, everyone knows him as the genius inventor who brought us the light bulb. But do you know how many times he failed before getting it right? Over 1,0 times? Can you imagine? You fail 1,0 times, and yet you keep going. Now that's perseverance. Edison famously said, "I have not failed. I've just found 1,000 ways that won't work." That attitude, my friends, is how you grow. You learn from every mistake, tweak your approach, and try again. Historians still debate whether Edison's relentless pursuit of success was due to sheer stubbornness or brilliant foresight. But the fact remains, he understood that failure wasn't something to avoid. It was part of the equation for success, and that's a mindset you can adopt. 2. In the world of finance, the fear of losing money often paralyzes us from taking action. But here's the thing. In order to make smarter financial choices, you've got to put yourself out there. That means you will make mistakes. You'll buy stocks that don't perform, or you might invest in a project that fizzles out. And that's okay, because guess what? Those failures are actually your best teachers. It's through these setbacks that you gain valuable experience that will help you avoid similar mistakes in the future. The key here is to fail fast. Don't let a bad investment linger for years. Don't sit on a poor decision hoping it will turn around. The faster you realize something isn't working, the quicker you can adjust. There's no shame in admitting a mistake. The real shame comes from refusing to learn from it. So, take a hit, learn from it, and move on. The quicker you embrace this mindset, the more resilient you'll become in the face of financial uncertainty. But here's the trick to failing fast without sinking your entire ship. Calculated risks. You don't want to throw your life savings into a single risky venture, right? No, you want to take risks that are manageable, risks that won't wipe you out if things go south. That's the beauty of diversification. By spreading your investments across different asset classes, stocks, bonds, real estate, even some alternative investments, you create a buffer. This buffer allows you to fail in one area without destroying your entire financial foundation. It's about minimizing the downside while maximizing the upside. Let's talk about an example from the world of investing. Venture capitalists, those brave souls who fund startups, are no strangers to failure. In fact, many venture capitalists expect that the majority of the companies they invest in will fail. But here's the kicker. Those few companies that succeed make up for all the losses. They understand that failure is part of the process, and they invest accordingly. They diversify their portfolio of investments, and over time, the wins add up. This approach minimizes risk while allowing for big rewards. Now, you might be thinking, that's all fine and dandy, Warren, but what if I'm not a venture capitalist? What if I just want to make smart choices with my savings? Fair question, and the answer is simple. Apply the same mindset. Start small. Don't bet the farm on one stock or one investment. Begin by making smaller, low-risk investments. And if one fails, don't panic. Learn from it, analyze what went wrong, and then apply that knowledge to your next move. Here's a quirky tidbit. Did you know that the famous investor George Soros made billions betting against the British pound in 1992? The trade was risky, extremely risky, and yet it paid off in a big way. But what many people don't know is that Soros had previously failed in similar trades. It was his ability to learn from his losses that allowed him to recognize the opportunity when it arose. And that's the point here. Soros didn't let failure stop him from continuing. He embraced it, learned from it, and eventually became one of the most successful investors in history. So, how can you start failing fast and learning faster? It's all about creating a system where failure is seen as an opportunity to learn, not something to avoid at all costs. The more you experience, the more you'll develop your intuition for what works and what doesn't. You'll begin to recognize patterns, and, over time, you'll make smarter, more informed decisions. Don't fear failure, embrace it. If you're not failing, you're not growing. And in the world of finance, growth is everything. The more you try, the more you learn. The more you learn, the better your financial decisions will become. And that's how you start winning. All right, Now that we've covered how to fail fast and learn faster, let's tackle one of the sneakiest little monsters lurking in the back of our minds, the what-ifs. You know them. They're those nagging, persistent thoughts that creep in whenever you're about to make a big financial decision. What if the market crashes? What if I lose everything? What if this investment doesn't pan out? What if I look like a fool? These what-ifs are dangerous because they paralyze you. They make you overthink, second-guess, and ultimately avoid taking action. And as we all know by now, avoiding action is the quickest way to miss out on opportunities. The fear of the what-ifs is something that keeps a lot of people from making smart financial choices, especially when it comes to investing. The truth is, worrying about the worst-case scenario won't prevent it from happening. In fact, it might just cause you to miss the opportunity to reap the rewards that come with calculated risk. Let's put this into perspective with a historical example. One of the most famous investors of all time, Benjamin Graham, was known for his value investing philosophy, which is essentially about buying undervalued assets and holding them for the long term. Now, Graham was no stranger to market volatility, and during the Great Depression, he saw some of his investments plummet in value. But despite this, he didn't panic. He didn't obsess over the what-ifs of market crashes. Instead, he stuck to his strategy, knowing that over time, value investing would pay off. And you know what? He was right. Graham made a fortune, and his teachings continue to influence investors today. Historians still argue over whether his principles are as effective in today's fast-paced market. But the fact remains that he wasn't shaken by the what-ifs, he just stuck to his plan. Now, let's zoom in on you for a second. You might not be living through the Great Depression, but your own financial decisions can feel just as daunting. Every time you're faced with a new opportunity, whether it's a stock, a new business venture, or an investment property, the what-ifs can start to creep in. And if you let them control you, you'll end up standing still, stuck in a cycle of fear and indecision. So, how do we break free from this cycle? How do you stop the what-ifs from calling the shots in your financial life? First, you need to accept that uncertainty is part of the game. Markets are unpredictable. Economies fluctuate. New risks emerge every day, and that's not going to change anytime soon. But here's the key. Uncertainty isn't something to fear. It's something to embrace. The world of finance, and life in general, is full of unknowns, but that's what makes it exciting. If everything were predictable, there would be no opportunity to grow or to profit. The key is to shift your mindset from worrying about the worst-case scenario to focusing on the best-case outcome. Let's consider a real-life example that might hit a little closer to home: buying a home. For most people, purchasing property is one of the biggest financial decisions they'll ever make. It's a huge commitment, and the what-ifs can start flooding in. What if the value of the house drops? What if I can't make the mortgage payments? What if I regret this decision in a few years? These thoughts can be paralyzing, especially if you're trying to decide between two properties or even just trying to pull the trigger in the first place. But here's the thing, there's always risk. There's no way to guarantee that the market won't drop or that your property will rise in value. But if you do your homework, understand the market trends, and assess your own financial situation, you can make an informed decision. And even if things don't go exactly as planned, you have the ability to adjust, to sell, to refinance, or to make changes along the way. The what-ifs will always be there, but they don't need to control your decisions. This brings us to something that's essential for overcoming the fear of loss: building a solid financial foundation. By making decisions based on a long-term plan, researching thoroughly, and being prepared for the worst, you minimize the impact of the what-ifs. You create a buffer that allows you to stay calm and focused, no matter what happens. Let's take another quick detour into the world of investing. The stock market is a classic example of the what-ifs in action. What if the stock drops? What if I lose my money? It's easy to get lost in these worries. But here's the thing, by adopting a long-term, value-based investment strategy, you can mitigate some of that fear. Stocks will rise and fall, but over time, the market tends to trend upward. The key is to focus on solid companies with strong fundamentals, rather than trying to time the market or chase the next hot stock. If you've done your research, then those what-ifs won't feel nearly as threatening. There's also a quirky lesson here. Do you remember the dot-com bubble of the late 90s? Everyone thought the internet was going to change the world. And sure enough, many tech stocks skyrocketed. But here's the kicker. Most of those companies didn't have the fundamentals to support their valuations. When the bubble burst in 2000, millions of people lost money. But the ones who weathered the storm were those who didn't get swept up by the hype. They understood that good companies with solid business models would survive the bust. They didn't panic. They kept their eyes on the long-term prize. Historians still argue whether the dot-com era was an economic anomaly or a lesson in the dangers of speculation. But the takeaway is clear. Don't let the what-ifs make your decisions for you. So, when the what-ifs come knocking at your door, acknowledge them, but don't let them drive the car. They're there, sure, but they're not in charge. Keep your focus on your strategy. Stay calm, and keep your eyes on the big picture. You'll find that the fear starts to fade, and the decisions become easier. Let's take a step back for a moment and talk about something you might find surprising. More money doesn't always lead to more happiness. That's right, sometimes. The pursuit of wealth can become its own trap. And this paradox of wealth is something that trips up a lot of people. Now, you're probably sitting there thinking, Warren, are you seriously telling me that more money won't make me happy? Well, hold on, let's dig into this a bit. To understand this, we need to take a journey back in time to one of the wealthiest men in history, King Midas. You know the story, right? He was granted the ability to turn anything he touched into gold. Sounds like a dream come true, right? But in reality, it became a curse. His food turned to gold. His daughter turned to gold. Eventually, he realized that his endless pursuit of wealth had left him with nothing but isolation and regret. Historians still debate the symbolic meaning of Midas's story. But one thing's for sure, his wealth brought him nothing but misery. It's a perfect example of how wealth, if it becomes the sole focus of your life, can become a source of stress rather than fulfillment. Now, I'm not saying that money doesn't matter. Of course, it does. You need money to survive, to live comfortably, and to achieve your goals. But the point here is that the more you focus solely on wealth accumulation, the more you risk sacrificing other things in your life that bring true happiness. Your health, your relationships, your peace of mind. The trick is to understand that wealth should serve you, not the other way around. Let's get into the psychology of this a little more. Studies have shown that up to a point, money does correlate with happiness. When you're struggling to pay bills or worried about basic needs, having more money can provide relief. But once you hit a certain threshold, the returns on happiness start to diminish. Beyond that point, the pursuit of more wealth becomes a never-ending cycle that can lead to stress, dissatisfaction, and burnout. In fact, some of the happiest people in the world aren't the richest. They're the ones who have found balance in life, who prioritize their mental well-being, and who value experiences over possessions. Take a look at Warren Buffett, for example. Yes, I know, I'm talking about myself again. But hear me out. I could have kept working and building wealth for the rest of my life. But at some point, I realized that the joy of wealth doesn't come from hoarding more of it. It comes from having the freedom to do what you love, to give back to others, and to live a life that aligns with your values. I'm known for living relatively modestly despite having billions, and that's intentional. I value my time, my relationships, and my health more than the endless pursuit of money. And that's the message I want to get across to you. Make sure your financial journey is about more than just piling up cash. Wealth is a tool, not the end goal. Now, let's look at a quirky example, the famous lottery curse. It seems like everyone's dream to win the lottery, right? Instant wealth, the ability to do whatever you want. But what often happens after someone wins big is a downward spiral of personal and financial disaster. In fact, studies have shown that a large percentage of lottery winners go bankrupt within a few years. Why? Because suddenly, they're thrust into a world of excess, where the rules of personal finance and happiness are thrown out the window. Without a deeper understanding of how to manage wealth, the rush of acquiring more can quickly turn into stress, disillusionment, and loneliness. It's important to recognize that more money doesn't solve everything. In fact, it often complicates things. Think about the stress of managing a massive portfolio of investments, the pressure of constantly making the right decisions, keeping track of ever-fluctuating markets, and worrying about the future. While financial security is vital, once you have enough to live comfortably, It's time to take a step back and focus on what truly matters: your well-being, your relationships, and your sense of purpose. The key is to shift your mindset from accumulating wealth for the sake of wealth to using money as a tool for a richer life. When you start to think of money as something that supports your values rather than defining your worth, you can make smarter, more balanced financial decisions. And this, my friend, is where you'll find true happiness, finding peace and contentment with the wealth you already have. Rather than chasing endless riches, let's talk about the role that financial independence plays in all this. When you've reached a level of financial security, you no longer need to constantly worry about the next paycheck or the next business deal. That's a huge weight lifted off your shoulders. Financial independence gives you the freedom to live life on your own terms. You can spend more time doing what you love, whether it's traveling, spending time with family, or just taking a break from the hustle. But this doesn't mean you should stop growing your wealth entirely. What it means is that you can now approach your investments with a more relaxed mindset. You're not scrambling to make ends meet or seeking the next big payday. You've already achieved enough to feel comfortable. And now your goal is to maintain and enjoy what you've built. This shift in perspective reduces the anxiety and stress that often accompany the pursuit of wealth. As you continue your journey toward financial peace, remember this: wealth, in its purest form, should be about freedom. Freedom to choose how you spend your time, where you live, and how you impact the world. It's not about chasing after more money. It's about building a life that aligns with your values and allows you to experience the kind of happiness that no amount of wealth can buy. Now that we've explored the paradox of wealth and how it doesn't always lead to happiness, let's dive into something equally important: financial independence. It's a term that gets tossed around a lot in personal finance circles. But what does it really mean? Is it just about having a ton of money? Or is it something deeper, something that gives you the freedom to make choices without being shackled by financial stress? First, let's break it down. Financial independence is the ability to cover your expenses with income from your investments, savings, or other passive income streams, without relying on a paycheck from a job. It's about having enough wealth that you no longer need to trade your time for money. Now, before you start dreaming about quitting your job and lying on a beach somewhere, who doesn't want that, right? It's important to understand that achieving financial independence is a process. It takes time, planning, and, let's be honest, sacrifice. But it's not just for the ultra-wealthy. It's something you can work toward. Regardless of your current financial situation, let me take you back to the roots of this idea. Historically, financial independence was something that only the wealthiest could achieve. But over time, as economies grew and financial systems evolved, opportunities for regular folks to gain financial independence started to emerge. Take, for example, the middle class in the 20th century. Before the rise of pensions and Social Security, most people relied on their own savings and investments to ensure they had a comfortable retirement. Those who succeeded in building wealth did so by focusing on savings, living below their means, and investing wisely over time. Fast forward to today, and the path to financial independence is clearer, but no less challenging, thanks to the rise of online platforms, side hustles, and the ability to invest in stocks, real estate, and other income-generating assets. The average person now has more opportunities than ever to start building wealth. But, as always, it's not about making a quick buck. It's about developing the mindset that will allow you to build long-term, sustainable wealth. Historians still argue about the best ways to achieve financial independence. Some swear by the FIRE movement financial independence, retire early, while others advocate for a more traditional approach of steady, consistent saving and investing. Regardless of which method you choose, the key is the same. Start with a clear plan, stick to it, and remain patient as your investments grow. But here's where the fear of losing money rears its ugly head again. When you start to think about financial independence, you're inevitably going to run into that fear of losing money. What if the stock market crashes? What if my rental property doesn't appreciate? What if my investments aren't enough to cover my living expenses? It's easy to get wrapped up in these what-ifs and lose sight of the bigger picture. The reality is, financial independence isn't about making every perfect decision or avoiding all risk. It's about reducing risk where you can and diversifying your investments to ensure that, Even if one stream of income dries up, you have others to fall back on. Diversification is key. By spreading your money across different asset classes, stocks, real estate, bonds, and maybe even some small business ventures, you reduce the likelihood of a single loss derailing your entire plan. It's about playing the long game, not chasing quick wins. Let me give you an example of diversification in action. Warren Buffett, yes, me again, has always preached the importance of owning a variety of investments. One of my most famous quotes is, "Don't put all your eggs in one basket." And I'm sure you've heard that one before. But it's not just some catchy saying, it's solid advice. If you put all your money into one company or one asset class, you're opening yourself up to a major risk. What if that company goes under? Or what if that market crashes? On the other hand, if you spread your investments across different areas, you're giving yourself a much better chance of weathering any storm. Financial independence isn't just about amassing a huge pile of money. It's about creating a foundation that allows you to live life on your terms. It's about being able to make decisions without the constant worry of whether you can afford it. And the beauty of achieving financial independence is that it gives you the space to pursue your passions, spend time with the people you love, and focus on what really matters. But here's the hard truth. Achieving financial independence takes time. You won't wake up tomorrow with a massive fortune unless you win the lottery. But we all know how rare that is. It takes years of diligent saving, smart investing, and, yes, learning from your failures. And along the way, you'll face setbacks. Maybe the stock market takes a dive, or your business venture doesn't pan out. But if you stay focused on your long-term goals, the rewards will come. And while you're working toward financial independence, remember that it's not all about just accumulating money. It's about the freedom and flexibility that come with it. The point is to have enough money that you're not constantly stressed about paying bills or living paycheck to paycheck. The point is to be able to make decisions based on what you want, not what you can afford. And that's the ultimate goal of financial independence. Freedom to live your life on your own terms. So, as you work toward your own financial independence, remember this: take it one step at a time. Don't let fear hold you back. And always keep the bigger picture in mind. It's not just about the money. It's about what that money can do for you and the kind of life you want to lead. Now that we've discussed the importance of financial independence and how to build a sustainable foundation for your wealth, let's talk about something that can significantly help you get through the ups and downs of the market: embracing uncertainty. The world of finance isn't a perfect machine. It's a chaotic, unpredictable environment. And if you're waiting for a time when everything is crystal clear before you make a move, well, you'll be waiting forever. Accepting uncertainty is one of the most important steps you can take to manage both fear and decision-making in your financial journey. Let me give you an example that might surprise you. Do you remember the 2008 financial crisis? I'm sure you do. It was a catastrophe that affected millions of people and sent shockwaves through the global economy. During that time, many investors were panicking, selling off their stocks at a loss, and retreating to safer options. But you know who thrived during that period? Investors like me again. Here I am, who understood that the market wasn't going to stay down forever. Those of us who stayed calm, stuck to our long-term strategies, and embraced the uncertainty were able to pick up valuable assets at discounted prices and come out on top. Here's the important part. Uncertainty isn't your enemy. It's a constant. Markets rise and fall. The economy will go through boom and bust cycles. You can't control it, and you can't predict it with absolute certainty. So, the question is, how do you deal with this volatility? First, you have to accept that the markets are inherently unpredictable. Economists and financial experts can make their best guesses, but at the end of the day, no one really knows what tomorrow holds. That's why, rather than trying to predict or control market fluctuations, it's far more important to build resilience into your strategy. Whether you're investing in stocks, bonds, real estate, or any other asset, diversification is your best tool. Diversification allows you to spread your investments across different sectors and asset types, reducing the impact of market crashes on your overall portfolio. If one investment takes a hit, you have others that will hopefully keep your financial ship afloat. Let's bring this back to you and your money. I know it's tempting to think that if you can just predict the next big trend or catch the next hot stock, you'll hit the jackpot. But chasing the next big thing can often lead to disappointment. It's easy to fall into the trap of looking at every market dip as a crisis that you need to avoid at all costs. But here's the truth. Every dip is also an opportunity. When stocks drop, it's a chance to buy at a discount. When the housing market cools down, it's a chance to invest in real estate. But to recognize these opportunities, you need to embrace the uncertainty of the market. You can't control it, but you can be prepared for it. Now, let's take a quirky example from the world of nature. Have you ever seen a storm rolling in? The clouds darken, the winds pick up, and you can almost feel the tension in the air. But here's the thing. While the storm might be scary in the moment, it's also necessary for growth. The rain nourishes the plants. The winds carry seeds to new places, and the storm itself is part of the ecosystem. Just like a storm, market uncertainty is inevitable, but it's also part of the cycle of growth. Without it, there would be no progress. If you only play it safe, you'll miss out on the opportunities that come with volatility. Historians still argue over how much control investors can really have over the markets. Some believe that with the right knowledge and preparation, you can predict market trends and make safe bets. Others, like me, believe that you need to embrace the uncertainty, accept that you can't control everything, and focus on managing risk, regardless of where you stand on that debate. The fact remains that the more comfortable you become with uncertainty, the better equipped you'll be to make smart decisions. So, how do you begin to embrace uncertainty in your own financial life? The first step is mindset. When you shift your focus from trying to control every outcome to accepting that some things are beyond your reach, you free yourself from the stress and pressure that come with overthinking. You start to view each financial decision not as a do-or-die situation, but as a part of a larger, ongoing journey. Every decision, every investment, every risk, it all adds up over time. Let's take a moment to think about it in more personal terms. Say you're debating whether or not to invest in a property. On the one hand, you could buy it now while prices are relatively low. On the other hand, what if the market drops further? What if your tenants leave? Or the property needs major repairs? The uncertainty can be paralyzing. But when you embrace uncertainty, you recognize that no investment is without risk. The key is to make sure your investments are diversified and that you have an emergency plan in place. If things don't go as expected, you can adjust. The goal isn't to eliminate uncertainty, but to navigate it with a steady hand. One more example. Think about the great investors who made their fortunes during the Great Recession. They weren't fortune tellers, they simply embraced the uncertainty and had the resilience to ride out the storm. The lesson here is not to fear market fluctuations, but to understand that they are an inherent part of the process. They create opportunities, and if you're prepared, you can take advantage of them. The bottom line here is this: the market is unpredictable, but your ability to embrace uncertainty and navigate through it with patience, resilience, and a long-term strategy will determine your success. When you stop trying to control every variable and start focusing on what you can control, your investments, your risk management, your mindset, you'll be better prepared to weather any storm that comes your way. By now, you've already learned a lot about the importance of embracing uncertainty, building financial independence, and learning to deal with fear in a way that allows you to make smarter decisions. But there's another essential aspect of wealth building that doesn't get nearly enough attention focus. In a world full of distractions, it's easy to lose sight of your goals, whether it's social media, the constant bombardment of financial advice, or the never-ending stream of news. There's always something vying for your attention. But here's the truth. If you want to make smart financial decisions, you need to focus, and not just in a "I'll focus for a few minutes and then get distracted" kind of way. No, this requires true, deep focus, laser sharp, sustained, and relentless. Let me tell you something that's probably going to surprise you. One of the best financial decisions I ever made was focusing on a few key investments and sticking to them for the long haul. I didn't get caught up in the hype of the latest trends. I didn't jump from one hot stock to the next, constantly trying to time the market. I focused on what I understood: businesses with strong fundamentals, steady growth, and the potential to thrive over decades. This kind of focus is what allowed me to amass a fortune, and it's something I still do to this day. Let's take a quick historical example to put this into perspective. In the 1980s, when I was still building Berkshire Hathaway, I could have jumped on every trendy stock and high-growth company that came my way. But instead, I focused on businesses I truly understood, like Coca-Cola, American Express, and Wells Fargo. At the time, people thought I was crazy. Coca-Cola was just a soda company, and Wells Fargo was hardly considered a sexy investment. But I knew they had long-term potential. I didn't get distracted by what was popular at the moment. I focused on the fundamentals. And guess what? Those companies have paid off immensely over time. But here's where the real lesson lies. Focus doesn't just apply to choosing investments. It applies to your entire approach to wealth building. Think about your financial goals. Are you trying to save for retirement? Are you investing in real estate? Do you want to start your own business? Whatever it is, the key to making progress is focus. If you spread yourself too thin, you'll find yourself unable to make meaningful progress in any one area. And just like with investing, if you're constantly jumping from one opportunity to the next, you'll never build the kind of wealth that comes from sustained effort. Here's a quirky little fact. Did you know that the average person spends around 2 hours per day on social media? That's roughly 730 hours a year. Now, imagine what you could do with all that time if you dedicated it to building your financial knowledge, analyzing your investments, or even just setting up a budget. The time you waste on distractions can be the difference between staying stuck and moving forward. Historians still debate whether the advent of social media and instant communication has improved our productivity or simply turned us into information junkies. But one thing is clear. The constant pull of distractions makes it harder than ever to stay focused on what matters most. And this applies to everything in life, but especially to wealth building. If you're constantly reacting to every bit of news or jumping into every investment opportunity that crosses your path, you're not building a solid foundation. You're just adding chaos to the mix. Now, let's talk about what focus actually looks like in practice. It means setting clear, actionable goals. If you're saving for retirement, don't just vaguely say, "I want to save more money." Instead, set a specific target. I want to save $10 this year for retirement. Then, break that down into smaller, manageable steps, automating your savings, cutting back on unnecessary expenses, or setting up an investment plan. This kind of focused effort allows you to make steady progress without getting distracted by the noise. Focus also means knowing when to say no. Every time you say yes to an investment or an opportunity, you're saying no to 100 other things. That's why it's so important to make sure that what you're saying yes to is in alignment with your financial goals. And sometimes, saying no can be just as powerful as saying yes. For example, you might be tempted to take on a risky investment that promises high returns. But if it doesn't fit with your long-term strategy or your risk tolerance, the best decision might be to pass. Being able to focus on your goals means knowing which opportunities to pursue and which to leave behind. Let's take another look at something I mentioned earlier, the importance of diversification. Diversifying your investments is a form of focus. 2. It's not about spreading yourself too thin across dozens of assets. It's about focusing on a few key areas: stocks, bonds, real estate, etc. But making sure you're covering your bases so that no single downturn can wipe you out. This requires a focused, strategic approach rather than a scattered, impulsive one. The key takeaway here is simple. Focus is everything. In a world full of distractions, the people who succeed are the ones who can filter out the noise, stay disciplined, and stay focused on their goals. Whether it's choosing the right investments, building a long-term plan, or simply managing your time wisely, focus is the secret ingredient that ties everything together. Without it, you'll be like a ship drifting in the ocean, lost and directionless. But with it, you'll have a clear path to success. All right, now that we've talked about the power of focus, let's dive into something that often trips up even the most seasoned investors: the psychology of risk. When it comes to making financial decisions, how you perceive risk plays a huge role in the choices you make. Many people see risk as something inherently bad, something to avoid at all costs. But what if I told you that risk isn't the enemy? It's actually a tool you can use to your advantage. The key is understanding how to manage risk, not eliminate it. Let's take a quick look at a piece of financial history that exemplifies how risk can be both a danger and an opportunity. In 1962, a man named John F. Kennedy made a bold decision to push for the establishment of the Apollo space program, with the goal of landing a man on the moon. At the time, the space race was an enormous gamble. There was no guarantee that the mission would succeed, and the financial risk was staggering. In fact, NASA spent billions of dollars on the project. Yet, this risk ultimately paid off, not only with the historic Apollo 11 moon landing in 1969, but also with the long-term technological advancements that came from it. If you were in Kennedy's shoes, would you have taken that risk? Well, the rest is history. Sometimes, the greatest rewards come from the riskiest decisions. In investing, risk often gets a bad rap because of the potential for loss. But here's the thing. Without risk, there is no reward. The real trick is learning how to manage that risk, to take calculated risks that align with your goals and values. Think of it like this. If you're standing on the edge of a cliff, the risk is obvious you could fall. But if you've done your homework, if you've equipped yourself with the right gear, or in the case of investing, the right knowledge, then the risk becomes manageable. You don't avoid it, you prepare for it. But it's not just about physical risks. The psychological side of risk is what really messes with people. Humans have an inherent bias known as loss aversion, which means we feel the pain of a loss more intensely than the pleasure of a gain. This can lead to irrational behavior, like holding on to a losing investment for too long in the hope that it will bounce back, or avoiding opportunities because we're too afraid of losing money. Psychologists have found that people are often more willing to take a big risk to avoid a small loss than to make a small gain. This kind of thinking can prevent you from making the smart, calculated decisions that are necessary for long-term financial success. Now, I know what you're probably thinking. I don't want to lose money ever. And that's totally understandable. But the reality is that in any form of investing, loss is part of the game. It's like playing poker. You're not going to win every hand. But if you play your cards right over time, you'll come out ahead. The key is to minimize your losses while maximizing your potential for gain. This can be done by making smart decisions, doing thorough research, and not letting fear dictate your choices. Here's a quirky tidbit. You've probably heard of the concept of the lottery curse, right? The phenomenon where lottery winners often end up worse off than before they won. They go from rags to riches and then back to rags. One of the main reasons for this is poor risk management. They don't understand how to handle the wealth they've just acquired, and as a result, they make reckless decisions that ultimately leave them worse off. Managing risk isn't just about avoiding losses, it's about understanding how to make your wealth work for you, to protect it from the inevitable ups and downs. Historians still debate whether certain investors, such as the infamous stock speculator Jesse Livermore, were geniuses or just reckless gamblers. Livermore made and lost several fortunes throughout his life, and his risky trading style often put him at odds with traditional investment wisdom. While some admire his boldness and willingness to take risks, others view his story as a cautionary tale about the dangers of taking on too much risk without proper preparation. So, how do you go about managing risk in your own financial decisions? First, understand your risk tolerance. Not everyone is cut out for high risk, high reward investments, and that's perfectly fine. Some people are comfortable with a moderate risk level, while others prefer a more conservative approach. The point is to assess your own comfort level and make decisions that align with your financial goals and your emotional tolerance for risk. Next, diversify your investments. You've heard this before, but it bears repeating. Diversification is one of the best ways to manage risk. By spreading your investments across different asset classes, stocks, bonds, real estate, etc., you ensure that a downturn in one area won't wipe out your entire portfolio. In fact, diversification helps smooth out the ride, making the inevitable ups and downs of investing a little less jarring. Finally, don't let fear dictate your decisions. Fear of loss is natural, but it should never control you. When you're making decisions, focus on the long-term goals you've set for yourself and make sure those decisions are aligned with your strategy. If you let fear take over, you'll miss out on opportunities. And more importantly, you'll limit your ability to learn from both your successes and your failures. The key takeaway here is simple. Risk is inevitable, but it's also manageable. The more you understand how to assess and manage risk, the more confident you'll feel about your financial decisions. And that confidence will help you make smarter, better choices over time. Now that we've tackled risk and how to manage it, let's dive into something that many investors overlook: The role of emotion in financial decision-making. It's easy to talk about keeping emotions in check when it comes to money. But the truth is, emotions are a huge part of investing. We are, after all, human, and we don't make decisions in a vacuum. So, how can we keep our emotions from derailing our financial journey? Let me start by giving you a personal example from my own career. In the 1990s, I watched as the dot-com bubble grew and grew. At the time, everyone was riding high on the success of tech stocks. It seemed like every new startup was the next big thing, and people were pouring their money into these companies at sky-high valuations, hoping for the next Microsoft or Google. But I didn't join the hype. In fact, I held back from investing in most of those companies. Why? Because the emotional frenzy around tech stocks was so intense that I could sense something wasn't quite right. People were allowing their emotions, fear of missing out, FOMO, greed, and excitement to drive their decisions, rather than the fundamentals of the companies they were investing in. As we all know now, the bubble burst, and many of those investors lost everything. Historians still argue about whether the dot-com bubble was inevitable or simply a case of mass hysteria. Regardless, what's clear is that emotions played a huge role in the rise and fall of those stocks. So, what does this tell us? It tells us that emotional decisions are often bad decisions, especially when it comes to money. Now, let's break this down a little further. The biggest emotional traps people fall into when investing are fear and greed. On the one hand, fear can cause you to pull out of investments too early or avoid making decisions altogether. On the other hand, greed can lead you to chase after quick gains, ignoring the long-term strategy and fundamentals that should be guiding your decisions. Think about it. During a market crash, fear takes hold of investors, and they panic sell their stocks at a loss. The emotional impulse is to get out before things get worse. But often, this is the worst decision you can make. By selling when the market is down, you lock in your losses and miss the potential recovery. In contrast, when the market is booming and everyone around you is celebrating big returns, greed can take over, pushing you to buy into risky assets without doing proper research. Before you know it, you've bought a stock at a price far beyond its true value. And when the bubble bursts, you're left holding the bag. But here's the good news. You don't have to be a victim of your emotions. By understanding them and learning how to manage them, you can make much smarter, more rational decisions. The key is to stay grounded and focus on the long term. It's about looking at the big picture, sticking to your strategy, and not reacting to short-term market movements. Let's look at another historical example to illustrate this point. In 1973, the stock market experienced a significant downturn due to the oil crisis, inflation, and other economic factors. Many investors panicked and sold off their holdings, fearing the worst. But those who remained calm and stuck to their long-term investments came out ahead. One of the most famous examples of this was the decision made by legendary investor Peter Lynch, who famously said, "The key to making money in stocks is not to get scared out of them." Lynch was a master at managing emotions and understanding that the markets were cyclical. What goes down often comes back up. If you stayed the course, the rewards would follow. But let's bring this back to you for a second. How can you apply this lesson to your own investing? The first step is to recognize when emotions are driving your decisions. Are you feeling anxious because the market is down? Are you getting greedy because everyone around you is making money? Once you've identified the emotional trigger, take a step back and evaluate the situation. Don't make any hasty decisions in the heat of the moment. Instead, go back to your plan, look at your long-term goals, reassess your strategy, and make sure that your decisions align with your overall financial objectives. Remember, patience is key. If you've done your homework, you know that the market moves in cycles, and this downturn, like the others before it, will eventually pass. Let's get a little more practical now. How can you manage your emotions in real time, especially during moments of market volatility? One technique is to set predefined rules for your investments. For example, you could decide that you won't sell any stocks unless they fall below a certain percentage, let's say 20%. Or you could decide to automatically reinvest any dividends you receive rather than constantly checking the market for the next opportunity. By setting these rules in advance, you take the emotional element out of the equation and remove the temptation to make knee-jerk decisions based on fear or greed. Another approach is to keep a calm, Rational mindset, by reminding yourself why you're investing in the first place. Your goal is likely to build wealth for the future, whether it's for retirement, buying a home, or securing financial independence. Keeping this in mind during times of market turmoil helps you stay focused on your long-term objectives, rather than getting caught up in short-term fluctuations. Finally, it's essential to take care of your mental well-being. Investing is stressful, and dealing with the emotional roller coaster of the market can take a toll. That's why it's important to build routines that help you manage stress and stay level-headed. Exercise, mindfulness, and even taking breaks from financial news can help you maintain perspective. The bottom line is this: emotions are a natural part of investing, but they don't have to control you. By staying focused on your long-term goals and sticking to a strategy that makes sense for you, you can weather the emotional storms that inevitably come with market ups and downs. Let's shift gears a little and talk about something that's key to maintaining a healthy financial future: diversification. You've probably heard this term before, but what does it really mean in the context of your financial decisions? The simple explanation is that diversification is about not putting all your eggs in one basket. But it's much more than just spreading out your investments. It's a strategic approach to minimizing risk and increasing your chances of success over time. The more you understand about diversification, the more you'll appreciate why it's one of the most powerful tools at your disposal. First, let's go back to a classic historical example. Back in the 1980s, when the Japanese economy was booming, many investors were diving headfirst into Japanese stocks and real estate. Everyone thought Japan was the place to be, the land of opportunity. But when the bubble burst in the early 90s, those who had put all their money into Japanese assets saw their portfolios crash. Meanwhile, investors who had diversified their holdings across different countries and industries weren't as severely impacted. Diversification isn't just about protecting yourself from a single bad bet. It's about spreading your investments across sectors, industries, and even asset classes so that your overall portfolio can weather any storm. Historians still argue whether the Japanese asset bubble was just an inevitable correction or a direct result of risky speculation. But the point is this: if you focus on just one asset or one type of investment, you're at risk of losing it all if that investment doesn't pan out. Diversification helps you balance that risk. By holding a mix of different investments, you give yourself more opportunities for growth, even if one area of your portfolio takes a hit. So, how do you start diversifying? First, think about asset classes. What's an asset class? Simply put, it's a group of investments that behave similarly in the market. For example, stocks, bonds, real estate, and cash are all separate asset classes. Each one carries different risks and potential returns. By holding a mix of these, you can reduce your exposure to any single type of risk. For instance, when the stock market takes a dive, bond prices often rise, and real estate can hold steady or even appreciate. Diversifying across asset classes helps balance out the volatility of any one market. Let's get a bit more specific. You don't have to be a financial genius to understand that it's important to have a range of investments. But many people make the mistake of focusing solely on stocks, thinking that this is the best way to make money. And while stocks can certainly bring high returns, they also come with a lot of volatility. If you put all your money into stocks and the market crashes, you could find yourself in a very uncomfortable situation. That's where diversification comes in. If you add other assets like bonds, which are generally less volatile than stocks, or real estate, which can provide a steady income through rents, you give yourself a safety net. It's also important to think about diversification within asset classes. Let's say you invest in stocks. Great, but don't just buy stocks in one sector. Diversify across different industries: technology, healthcare, energy, and consumer goods. For example, each of these sectors has its own risk profile and will respond differently to economic changes. If one sector takes a hit, others may perform better, helping to balance out your portfolio. Remember, the goal is not just to make money, it's to minimize risk and ensure your wealth grows steadily, no matter what's happening in the market. One quirky but insightful example of diversification comes from the world of farming. If you only grow one crop, like corn, and a bad season hits, say, a drought, you're looking at a total loss. But if you grow a variety of crops: corn, soybeans, wheat, and others one bad season won't ruin you. You're hedging your bets, so to speak, and ensuring that even if one crop fails, you still have others to rely on. The same principle applies to your investments. It's not about finding the one perfect investment. It's about spreading out your bets so that you can reduce the impact of any single loss. Now, here's something interesting: geographic diversification. While most investors focus on diversifying within their own country, it's also a good idea to look abroad. Different countries and regions experience different economic conditions. For example, the U.S. economy may be in a downturn, but emerging markets in Asia or Africa might be booming. By investing in foreign markets, you're adding another layer of diversification to your portfolio. Sure, international investments come with their own set of risks, such as currency fluctuations and geopolitical instability, but they also open up opportunities for growth that may not be available in your home country. Historians still debate whether global diversification is more effective than domestic diversification. Some argue that global diversification spreads the risks even further, while others believe that focusing on domestic markets can yield higher returns. But the fact remains, diversifying globally is a way to tap into new opportunities and protect yourself from the risks that come with concentrating your investments in one region. Now, let's talk about a topic that's near and dear to my heart: real estate. Real estate is often overlooked as an asset class, especially in the early stages of investing, but it can be a powerful tool for diversifying your portfolio. Real estate has a long history of offering steady returns and providing a hedge against inflation. Even though property values can fluctuate, real estate generally appreciates over time, and it can generate passive income through rent. This makes it an ideal addition to a diversified portfolio. Real estate is also less volatile than stocks, making it a great way to balance the ups and downs of other investments. The beauty of diversification is that it smooths out the ride. Sure, there will still be bumps along the way, market crashes, economic recessions, and all sorts of unexpected events, but with a well-diversified portfolio, you'll be much more resilient in the face of these challenges. The idea isn't to eliminate risk completely, because that's impossible. It's about managing risk and making sure that one bad decision doesn't wipe you out. So, how can you start diversifying your own investments? The first step is to evaluate your current portfolio. Are you overly reliant on one asset or sector? Do you have a healthy mix of stocks, bonds, real estate, and cash? Once you've assessed your portfolio, consider adding different asset classes, industries, or even international investments to your mix. And if you're new to investing, don't worry, you don't need to do it all at once. Start small and build up your diversification over time. The key is consistency and patience. In conclusion, diversification is one of the most effective ways to protect yourself from risk and build wealth over time. By spreading your investments across different asset classes, sectors, and geographic regions, you give yourself the best chance of success in the long run. It's not about getting rich quick, it's about steadily growing your wealth in a way that minimizes risk and maximizes opportunity. Now that we've explored the importance of diversification, let's take a moment to discuss a concept that's probably one of the most powerful financial strategies of all: compound interest. If there's one thing that separates those who build significant wealth over time from those who don't, it's understanding how compound interest works. But don't worry, we're not diving into some boring mathematical lecture. We're going to keep this practical, because compound interest is one of those magical financial concepts that you can leverage to your advantage. And trust me, once you understand it, your perspective on money will change forever. Let's start by breaking it down. Compound interest is the interest on a loan or deposit that's calculated based on both the initial principal and the accumulated interest from previous periods. In simpler terms, it's interest on interest. Imagine you have $1.00 in a savings account with an interest rate of 5% per year. After 1 year, you'll earn $50 in interest, right? But the next year, you won't just earn 5% on your initial $1. You'll earn 5% on your new balance, which is $1. That's compound interest at work. It allows your money to grow faster over time. Here's a quick historical example to show you just how powerful compound interest can be. In the 18th century, The famous mathematician and philosopher Albert Einstein reportedly called compound interest the eighth wonder of the world. Why? Because it's a simple concept with profound consequences. Let's look at the story of a man named Andrew Carnegie, one of the wealthiest men in history. Carnegie made his fortune by investing wisely and allowing his investments to compound over time. Through a combination of intelligent investments and patience, his wealth grew exponentially. Despite the fact that he didn't start with massive amounts of capital, he understood that if you invest early and let your money grow, it compounds into something far greater over time. Historians still debate whether Carnegie's true wealth came from his investments or from his steel empire. But what's clear is that his long-term approach and understanding of compound interest played a significant role in his success. And here's the best part. You don't need to be a billionaire like Carnegie to benefit from compound interest. In fact, anyone with a savings account, an investment portfolio, or even a small side business can take advantage of it. So, how do you harness the power of compound interest? The first step is start early. The earlier you start investing, the more time your money has to compound. Let me illustrate this with a simple example. Imagine you're 25 years old, and you decide to invest $1.00 in an account that earns 5% annual interest. By the time you turn 65, that $1.00 will have grown to over $7 thanks to compound interest. But here's where it gets even better. If you make regular contributions, say $100 per month, that $1.00 could turn into over $200 by the time you retire. The key here is the power of time. The earlier you start, the less you have to invest to reach your goals. Let's take this one step further. Compound interest isn't just for your savings accounts or retirement funds. You can apply it to investing in stocks or real estate as well. The trick is to reinvest your earnings, whether that's dividends from stocks or rental income from properties. By doing so, you allow those earnings to compound, building your wealth faster than you could ever achieve through simple savings alone. Now, I know what you're thinking. But what if I don't have a lot of money to invest right now? Don't worry. The key is consistency. Even if you start with a small amount, over time, your money will grow. The most important thing is to start, even if it's just a little bit. By making regular contributions and letting time do its work, you'll be amazed at how your wealth can snowball. Here's a quirky fact to wrap your head around. Did you know that the legendary investor Warren Buffett made the majority of his wealth after the age of 50? This is a great example of the power of compound interest at work. While Buffett started investing at a young age, the majority of his wealth came from letting his investments compound over several decades. His fortune grew at a staggering rate, thanks in large part to the ability to reinvest and let time and compound interest work its magic. Historians and financial experts continue to argue about the exact formula for building wealth. But one thing is undeniable. Compound interest is a cornerstone of long-term financial success. It's the reason why even small, consistent investments can grow into large sums over time. It's the secret that can turn modest savings into a comfortable retirement, or even a financial legacy. So, how can you take advantage of compound interest in your own life? The first step is to make saving and investing a habit. Treat it like a monthly expense that you don't think twice about. Automate your savings or investment contributions so that you're consistently growing your wealth. The second step is to be patient. Compound interest works best when you allow it to build over time. Don't get discouraged if you don't see massive returns in the short term. Remember, the magic happens when you give your money enough time to grow. The key takeaway here is this. Compound interest is the most powerful tool in your financial toolbox. The earlier you start and the more consistently you invest, the more your money will work for you. It's the ultimate wealth-building hack, and it's available to everyone, regardless of income or background. All right, we've discussed how powerful compound interest can be in growing your wealth. But there's another critical concept that often gets overlooked. Mentors and advisors. You see, no one builds great wealth in a vacuum. Every successful investor, entrepreneur, or financial genius has had help along the way, whether it's from reading the right books, listening to podcasts, or learning from the mistakes of others. Mentorship plays a crucial role in making smarter financial choices. Let's take a look at one of the most famous mentor-mentee relationships in the world of investing. Warren Buffett and Benjamin Graham. Graham, who is often referred to as the father of value investing, taught Buffett the principles that would guide his career. While Buffett had the brilliance and ambition to succeed, it was Graham's mentorship that helped him understand the importance of focusing on undervalued businesses, investing with a margin of safety, and thinking long-term. If Buffett hadn't crossed paths with Graham, who knows how his career would have unfolded? Historians still debate whether Buffett would have achieved the same level of success without Graham's guidance. But what's clear is that mentorship played a vital role. And while not everyone can have a legendary figure like Benjamin Graham in their corner, finding the right mentors and advisors, whether in person or through resources, can drastically shorten your learning curve and help you avoid costly mistakes. Now, I know what you're thinking, but I'm not a billionaire. I don't have access to legendary figures in the financial world. You don't need to have Warren Buffett on speed dial to benefit from good mentorship. There are countless ways to find mentors in the world of finance, and they don't all have to be high-profile figures. It could be a trusted financial advisor, a family member who's good with money, or even online communities where like-minded individuals share insights. Sometimes, mentorship comes from the most unexpected places. But here's the thing, finding the right mentor isn't just about seeking someone who has already made it. It's about learning from someone who has experience in areas where you're lacking. For example, if you're new to investing in stocks, you might seek out someone who has been in the game for decades. Or if you want to invest in real estate, you'll want to find someone who has experience managing properties. Having someone to guide you through the rough patches can make all the difference when it comes to making smarter financial decisions. Let me share a quirky example to make this clearer. In the 1800s, there was a man named Charles Schwab, who became one of the wealthiest industrialists in the United States. But Schwab didn't build his wealth alone. He had a mentor, the steel magnate Andrew Carnegie, who taught him how to manage money, how to invest, and perhaps most importantly, how to find and work with the right people. Schwab's success wasn't just about his own talent. It was about learning from those who had been there before him. The role of a mentor or advisor goes beyond just offering advice. They can help you avoid the common pitfalls that most beginners fall into. For instance, one of the biggest mistakes people make when they start investing is jumping into too many different things without truly understanding them. A mentor can help you narrow your focus, find investments that align with your goals, and guide you through the emotional roller coaster that investing often entails. Now, let's talk about the other side of the coin: advisors. Financial advisors, wealth managers, and even robo-advisors are all part of the equation when it comes to building wealth. But how do you choose the right one? It's easy to get lost in the sea of options, and not every advisor is created equal. You want to find someone who not only has the right credentials, but also understands your unique financial situation and goals. It's important to ask the right questions before you hand over your money. Do they understand your risk tolerance? Do they offer advice that aligns with your long-term goals? And just as importantly, do they have a track record of success? A good advisor doesn't just tell you what to do, they educate you and empower you to make informed decisions. They should be there to guide you through the process, offering advice when needed and stepping back when it's time for you to take the reins. Think of them as a coach. They help you refine your strategy, provide guidance when necessary, and hold you accountable for the decisions you make. And if you're wondering whether it's worth paying for professional advice, consider this. Many wealthy individuals rely on the expertise of their advisors, and they often see substantial returns on their investments. The key here is understanding that the right guidance can help you avoid costly mistakes, maximize returns, and create a more solid financial foundation. In fact, studies have shown that investors who work with advisors typically see better outcomes than those who go it alone, especially when it comes to managing risk and sticking to a disciplined investment strategy. Historians still debate whether financial advisors are necessary for everyone, with some arguing that self-directed investing is just as effective. However, the consensus is clear. The value of good advice cannot be overstated, especially for those who don't have the time or expertise to manage every detail of their financial lives. If you're serious about building wealth, it's worth considering how mentorship and professional advice can elevate your journey. Having someone who has been through the ups and downs of investing, someone who can offer perspective and guidance, can be the difference between making smart decisions and making costly mistakes. In the end, you don't have to navigate the world of finance alone. Whether it's a mentor, an advisor, or even a financial community that shares your interests, find the support that will help you stay on track. The smartest investors are those who are continually learning, seeking guidance, and applying that knowledge to make better decisions. As we reach the final stretch of this journey, it's time to reflect on the bigger picture, achieving financial peace. This is where it all comes together, the strategies, the lessons, and the mindset shifts. Throughout this series, we've explored a variety of concepts, from embracing uncertainty to understanding the power of compound interest, and from managing risk to seeking mentorship. But the ultimate goal isn't just to accumulate wealth. It's about creating a life where you have the freedom to make choices based on what matters most to you, whether that's spending time with loved ones, pursuing your passions, or simply enjoying the security and comfort that comes with financial peace. Financial peace doesn't mean having an endless supply of money. In fact, the pursuit of more wealth without a clear understanding of why you want it can often lead to stress, burnout, and a constant feeling of never having enough. True financial peace is about knowing that you've built a solid foundation for your future and that you've made the right decisions along the way. It's about feeling confident in your financial choices and being at peace with the journey you've taken, regardless of the bumps in the road. Let's go back to a concept we've touched on before, the long-term mindset. As we've discussed, wealth building isn't a get-rich-quick scheme. It's a journey that takes time, patience, and consistent effort. It's easy to get caught up in the rush for immediate rewards, especially in today's world of instant gratification. But true financial peace comes when you step back and realize that the small, consistent actions you take today will have a massive impact on your future. It's about having the wisdom to know that financial success is a marathon, not a sprint. Now, let's talk about something that can help you stay grounded throughout this process. Gratitude. It might seem odd to bring up gratitude in a conversation about financial success, but hear me out. Gratitude is a powerful tool for maintaining perspective. It reminds you to appreciate what you have, rather than constantly striving for more. When you're able to be grateful for the progress you've made, you're less likely to fall into the trap of comparison or envy. You'll feel more content with what you have, knowing that you're on the right track. One of the most effective ways to foster this sense of gratitude is by regularly reflecting on your financial journey. Take a step back every once in a while and look at how far you've come. Maybe you've paid off debt, built up a healthy emergency fund, or started investing for your future. Celebrate those wins. These milestones, no matter how small they may seem, are part of the larger journey to financial peace. And remember, financial peace isn't just about your money, it's about how you relate to it. It's easy to fall into the trap of thinking that more wealth will solve all your problems. But the truth is, money only amplifies what's already there. If you're constantly stressed or anxious about money, more of it won't magically fix the underlying issues. True financial peace comes when you have a healthy relationship with your money. You know where it's going, what it's doing, and how it's helping you achieve your goals. Let's take a historical example here. Henry Ford, the founder of the Ford Motor Company. Ford amassed significant wealth, but his approach to money was unique. He didn't just focus on accumulating wealth for the sake of wealth. He had a vision for how he wanted to impact the world, how he wanted to change the way people lived and worked. His wealth came as a byproduct of his vision, not the other way around. Ford's approach reminds us that financial peace isn't about making as much money as possible. It's about using your resources to live a life that aligns with your values and goals. This brings us to another important point: living within your means. It's easy to fall into the trap of lifestyle inflation, where the more you earn, the more you spend, but this is where financial peace can really get disrupted. If you're constantly chasing after the next upgrade, the next luxury item, or the next status symbol, you'll never truly feel content. Financial peace comes from understanding that you don't need more to be happy. You need to be content with what you have, while also being smart about growing your wealth over time. If you've been following along, you've probably noticed that every strategy we've discussed ties into a broader philosophy of wealth building, one that's about balance. It's not about extremes. It's not about hoarding or overspending. It's about finding a rhythm that allows you to build wealth while also living a fulfilling life. Finally, Let's end on a note about the legacy you'll leave behind. Achieving financial peace isn't just about the money you accumulate in your lifetime, it's about the impact you make on others. Whether it's through helping your family, supporting causes you believe in, or creating opportunities for future generations, your wealth can be a powerful tool for good. When you achieve financial peace, you're not just securing your own future, you're laying the groundwork for the legacy you want to leave behind. Take a moment to think about your own financial journey. Where do you want it to take you? What do you want your legacy to be? Whether it's teaching others about money, helping those in need, or building something that will outlast you, remember that financial peace is about much more than just dollars and cents. It's about living a life that reflects your values, creates opportunities for others, and allows you to feel confident and fulfilled in the choices you make. In conclusion, financial peace is attainable for anyone willing to put in the effort. Stay patient and make smart, strategic decisions. It's not about having unlimited wealth, it's about understanding the value of what you have and using it wisely. With the right mindset, a clear plan, and a focus on long-term goals, you can achieve the financial peace you've always dreamed of. And remember, the journey isn't just about the destination. Enjoy the process, celebrate the small victories, and know that every step forward brings you closer to the life you want.